And in this particular event, I will be telling you this weekly trend reports, whatever is being generated from our end, it has lot many things to speak you about the market trend and all. Though it is the only Fibonacci ratio is being added into that, but the price range which is being derived for this weekly trends, that is much accurate. For that reason only you used to get a very close near levels in your trade. And if you look into the previous weeks data, previous weeks, whatever the things we have calculated, Monday market opened and the first trade when it has given a breakout in the downside direction here 7553. However, it has failed and it triggered the stop loss 7612 level, and that triggering action, as I have already explained in one of my follow-up email, it was some 3000 plus losses it has given you, post which the upward journey has started, and Monday you have closed at 7695, which is very close to, not only close, almost equal to the point 888 retracement what we have calculated. Tuesday, which was yesterday, so it has made a high of 7738, which is exactly the 1.236, and it has closed at 7730, and today it has crossed this level 7785 and gone to higher level. So if you have taken in the software, you will be having the second cycle also. In the second cycle, maybe couple of levels you would have succeeded by this particular method. So second cycle, which starts from 1.236 from here. So you may have succeeded in certain levels in this particular thing. However, in this newsletter, I used to give only the first cycle. So the concept is very simple here. The price we are taking, we are deriving a volatility we are taking, and number of days we are taking as a 7 for weekly days, and we are dividing the entire result by square root of 365. So here question comes, why this is 7 calendar days I have taken? Why not any other number of days? Because this week we have worked only for 3 days. So why I have not taken for 3 days? Why 7 days? So whenever we trade in any of these future instrument, we have a cost of carry associated, and cost of carry is derived again from your interest rate, and money always has a interest component associated with this in holidays also, in vacations also. Hence for that 7 calendar days I have taken for projecting that. That is the reason behind selecting the 7 calendar days, because money always has a value, money always has a interest component associated with that, and that decides your cost of carry. That is the reason why we are taking this calendar days, not the working days. Second point, once you look into this formula, we have a very important component here, which is volatility. Price information you can get from the last traded price we are considering. Last traded price and settlement price both are different. Last traded price is the actual price at which the trade is being executed in the last minute of your trading cycle. So that last traded price we are considering, and then the volatility. So this volatility what we are considering for projecting these levels is the real-time volatility, and that real-time volatility is being derived through a complex process, and that is the copyrighted part of our method, and that is the concept behind success behind this method. This method success is sitting in this particular volatility. So it is through a complex process we calculate this particular volatility. And that is not the subject of this discussion. Discussion comes to that. We got a price range, we calculated, we used it, and we got these levels. Now how to work on these levels? That is very important. Once you get this particular level, we have to understand this Fibonacci in detail. So Fibonacci says, as in the first session of Fibonacci I have told, the 0.236 retracement price crossover either in the upside or downside direction, it sets the trend. Setting of trend means it just gives you an information that yes, uptrend has started, downtrend has started. Once you cross this 0.382 retracement, that confirms that your trend is confirmed, but that doesn't give you guarantee that trend will never reverse back. It just confirms the trend. Once this confirmation comes, then easily you can achieve this 0.618, and once this level of 0.618 is reached, little bit of consolidation you can face, or a prolonged period of consolidation you can face. So that depend upon how long you will face the consolidation. That is also very important. You have taken a reference of 587583. From there we have calculated these levels. So whatever time it has taken to give a crossover, this is very important. In Fibonacci, this is very important concept. Whatever the time it has taken to give you a crossover of 0.236, 3x of the time, if it has taken X amount of time in the minute or hour or days, so that 3x of the time maximum it will take to give you a breakout of 0.618. The consolidation after touching this 0.618 will be 3x times. So if you have taken 15-minute time to reach this 75832 to 7612, then you have achieved the target of 0.618. Here you are consolidating. You can say that for 1 hour you can consolidate there. Sorry, 3 into 15, 45 minutes you can consolidate there. So 3x is the maximum time it can give for the consolidation. Beyond 3x time, if it doesn't give you a breakout, so you can say that if it is still 7x time, x means is the time, 15 minutes, 10 minutes, whatever. 7x time, till 7x time, if it doesn't give you a breakout and doesn't able to cross this 0.618, then you can say that trend may reverse from this. So here one very important concept of timing the trade I am telling you. You have got a breakout, you have achieved a success, first success you got, then you are finding out the price is not able to move beyond that. You wait for 3x time. If x is the 15-minute time, you have it has taken from your reference price to breakout. In a day, Monday, it has started, say 9:15 market opens, you are getting a buy entry at 10 o'clock. So 45 minutes you have taken to get this buy entry. So 9:15 market open, 10 o'clock, so 10 to 9:15 it is 45 minutes. And after that, say after 15-20 minutes or half an hour, you got the first target. After touching this first target, price is consolidating. It is not going to second target. Wait for 3x time. Means if you have taken 45 minutes, so 45 into 3, so whatever the value comes, you calculate in hours. That much of time you give the price to cross over this level and penetrate this death zone. If successfully it penetrates, then it is okay. You can wait for the higher targets. But if it fails, each time it goes to 786, comes back, not able to cross this death zone for 7x time. If x is 45 minutes, 45 into 7, then you can say that this trend what has given me the success, having the high probability to fail and come back. So this is the timing of the trade as per the Fibonacci principle. So this is nothing to do with our concept. It is just a pure Fibonacci principle. And once you get a crossover of 0.786, then you have a 0.888 and then you can enter to the growth zone 1.236 and 1.618. And closing basis you have to see if you manage to close slightly up or down by few points from any of these trend levels, then you can say that next day also can give you a higher trend breakout or higher levels you can get. So by this process you can rely on this trend. So this is how you can utilize this particular levels as far as time is concerned. As far as time is concerned, because many of you already asked me, after this trend breakout happens, after I received this, got this success of fast target, prices is not moving, so what I should do there, whether I am at a profit, whether I should book a profit or come out, or I should wait for some time for a higher target. If I am waiting, how long I will wait? So for that reason only I have told you 3x and 7x is the concept behind this particular timing the trade. So once you enter this particular trade, now question comes how you manage this trade. Because once you enter a future trade, you are taking a few lakhs of rupees into the risk, so you have to manage your risk through specific method. So here two concepts comes into picture. One is the identification of your range bound market. Second is setting of your trailing stop loss. Most probably you want options to hedge. Either you can buy some opposite direction options or you can write up some options to hedge your trade. So whenever the instrument which you are trading having maintaining a volatility less than 15%, you can say that your range bound trend will be acting as from 0.5. If it is going less than 10%, then your range boundness will be around 0.38 to retracement. Means if it is annual terms, the volatility is 9%, I can say that Nifty is going to consolidate in the band of 7631 to 7535. If Nifty is having a volatility less than 15%, I can say that it can have a consolidation in the band of 7646 to 7520. And if it is having more, then you can think of 0.618 is your range bound band for the day. Yeah, this is also a question many of you have asked me. Certain times you are using 0.382, certain times you are using 0.5, certain times you are using 0.618 in this range bound things. Whether it is a typographic mistake or this is being done deliberately based on certain facts. So that is what I have told you. Now coming back to that hedging point. When you hedge a trade, so what will be your basic objective? Can any of the things? All of you, those who have given the views, everyone is correct in this particular aspect. The word of hedging we understood better. So now question comes, what kind of hedging strategy I should implement? That is very important here. So when my objective is for 1 week, I am going to use this particular things for a 1 week period. What kind of hedging I should utilize? Whether I should buy one option at a particular time or I should sell some options at that particular time, or I should do specific complex hedging. So based on your skill only you should hedge. That doesn't have any implication with respect to the trade. If you have a lesser skill in the hedging, if you do not understand what is the delta, vega, theta and other things, better with a long future have a long put option, or with a short future have a long call option. So that will be the simplest hedging technique you can follow if you do not understand the very basics of the delta, theta, vega, etc. However, if you understand that fact of delta, theta, vega, etc., then you need to hedge it with proportion to the delta. So whenever you are in a very low volatility territory, if you are in a very low volatility band, So what is a low volatility band, medium and high? We have a proper definition in smart finance. We never say that low volatility because it looks like low volatility. That is why low volatility. We have a scale for that. Those who have already attended our earlier programs, in many programs I have told you, low volatility means whenever you are having an annual volatility less than 20%. High volatility means whenever you are having a volatility above 40% annual terms, and whenever you are having a volatility in between this particular band, you can say it is a medium volatility market. So this is how your volatility defines. So volatility also has one more definition associated with this. Whenever you have a volatility, that means higher volatility means you have a higher chance of oscillation. Higher chances of oscillation, higher chances of giving you a triggering, higher stop loss triggering, higher chances of achieving all targets in the shortest time frame. So three things you can draw from this high volatility. If any instrument is having a 40% volatility in annual terms, it has a higher probability to touch the stop loss. It has a higher probability to touch all targets. So it has probability to touch all targets in a very smallest duration of time, though we time the trade for 7 days, but we may achieve this target much before that. That also the meaning of the volatility. In such a scenario of high volatility, what happens, your options used to be very pricey. The price of options, the premium of options used to trade very high. So in that case, while going for such kind of hedging, so you need to derive a specific method, or you need to look into a particular factor for deciding upon this option. So I am telling you a very simplest fact here. Assume Nifty is having some 40% volatility. Assume this, though it is not having. Now it is some 11 point something. Assume it is currently trading at a 40% volatility. This is an assumption only, just to understand a concept. And it has given you a uptrend breakout at 7889. So this is for the next week. I have calculated for the coming week. So this week has ended now. So this is the levels I have calculated for the next week, which will be circulated to you tomorrow by the email, 18th to 22nd. So in this particular method, I am saying that yes, uptrend is sitting here 7889. If you are buying the future here, you must buy one option which is close to 7830. So I am saying that you buy a 7850 put option. And this put option, since I have assumed 40% of volatility, assume this put option is quoting at 150 rupees. Now, so I am expecting if I can achieve the 0.618 also in the 100% retracement, the 100% of retracement if I can achieve by this process, I am going to achieve only 125 points. In future, if I achieve 100% of retracement level as per the Fibonacci, and I want enter to 1.236 and all, it is a growth projection. Even though if I achieve that much, so assume my point of expectation is 125, though it is being derived from a 11 point, so that time it will be different. So assume I have only expectation to achieve 120 points profit in my trade. Out of that, 0.236 also is gone. So part of that profit also I have already 29 points, it is gone in that. So you can say if I have a probability to get only 100-point profit in this particular trade, and this option which I am going to hedge, it is quoting at 150, then it is not advisable to buy a put option with a long future. That is also is very important. When your reward in terms of the future trade is lesser as compared to the premium what you are paying to the market, so that time you should not buy this option. Then what is the next alternative available in my hand? So even though if I achieve all successes, I have a chance to go till 8062. So if I can do these things, if I buy this future, Very carefully you listen this. I buy this future, also hedge it with 7850 put option, whatever the price it is available. Considering this is a high volatility trend. And I am selling a call option, means one covered call I am forming. I am selling a call option of strike higher than 8062. This much only maximum I am expecting. So if I can just sell that, and by that process if I can able to manage a part of my money, then it will be better. So here, before hedging, my point is, before hedging you should see how much premium you are giving for the option to hedge that particular trade of future, how much you are going to earn if that particular trend calculation is going to be successful. If both are giving you a divergence view, the reward in future trade is not enough to meet the options premium what you are paying, then it is not worth to buy the options. Though option will not be decayed to zero at that time, some residual value will be there. So if that kind of scenario you are finding out, then it is not good to buy the option that particular time. You can think of some other strategy. Similar way also you can able to form in the Bank Nifty. Similar way you can form in any stock of your choice. So you have understood how to identify this range bound trend based on their volatility condition. You have understood how to hedge that future long position based on their volatility condition. So these two things you have understood, and it has a particular example also. I'll give you one more example also. I'll give you one more example. So this is the view of Infosys. It is telling that 1186 above you should buy and 1165 below you should sell, and it is having a 1176 now trading. Imagine it has hit 1186, we are buying. So nearest option we have to look into. So nearest option of the Infosys, if I can go for 1186 level, I just want to buy. 1186 means, so my downtrend is coming at 1165. So nearest strike is 1160. Look into this option, which is having a 38 rupees. IV is quoting at 51. So 38 rupees it is quoting. 38 rupees it is quoting, 38.5 in fact. So the option which I should hedge with my long trade is 1160 option, which is 39 rupees approximately it is trading. This is of strike 1160 put option. If this trade gives me the success, if this trade gives me the success, say 0.786 and beyond that also, imagining this death zone is my maximum penetration, I am going to get here 87 means 13 rupees and here is 12 rupees. So 13 plus 12, 13 plus 12, this is going to give me 25 rupees only if the trend is reversing from this death zone. If it is going beyond that zone, I will be happy. But till 0.786 I have this much of value. I can say 100 point retracement, if I can add another 10 rupees I may add. So I have total reward sitting at some 35 rupees, and to hedge this trade I am paying 40 rupees. So this is not an ideal case of hedging a future with an option. So hedging a future with a buying of option. If you buying a put option with a long future, or if you sell a future with a call option, this is not an ideal case. So this is a thing I wish to convey you. You must take care that you should not pay more than your reward point for hedging. Manage it. Even though if you pay, you should manage it. So this is what about the hedging component. Now fixing this trailing stop loss. Fixing this trailing stop loss, that is also is very important for your trade. So while fixing this trailing stop loss, initially you got a trend breakout, buy or sell. Then your first trailing stop loss, trend breakout, you have got a first target. Till you have not achieved the target, you cannot able to fix up a trailing. Once you achieve the first target, your trailing stop loss is 0.382. level you can take. Once you achieve the second target, which as per this report, which is I am taking at the second target as 0.888, 0.786 above, that time I am telling that trail it to 0.5. But once you achieve 1.236 target, that time trail your stop loss to 0.786 or 0.888. You have to little bit conservative because good amount of profit you have added, so do not sacrifice it. And once you cross this 1.618, put a trailing at 1.236. And do not hurriedly quit the trade. If you are hedged, do not hurriedly quit the trade. Wait for some time, wait that price which has triggered, let it stabilize for a period of that 3 to 5 minutes or whatever the rule of 3x or 7x I have told. When you have got a breakout, achieved a stop loss, at that time you just wait for some time to stabilize. Once that price is stabilizing in that, then you can say that yes, some amount means this is the proper time to book the loss and come out. So this is how you should fix it really. And for the next week, this is the calculation for Nifty and Bank Nifty. So I am expecting the Bank Nifty uptrend to be above 7890, and if gives you the success, the first target will be 7938 and post which 8062. And if you are getting the downtrend is 7830. If penetrates 7783, then you can think of higher targets and maximum you are going to achieve 7657. So this is what I have calculated for the Nifty future for next week. And Bank Nifty similar way also I have calculated. So it is 16,400 and 16,165 because it is base value is more 16,000. Henceforth I am just saying that instead of 0.236 wait for the trend confirmation, then you enter. So this is for the Bank Nifty levels which is being calculated as per the honest. So this is things. It is not that that level only has given you the success and all. It is not only the level. If you just look into that last week's Nifty levels, whatever the calculations we have given and how far it has succeeded, and if you look into that thing is very careful way, it is not that a trend but it has given the breakout. 11th was the first trading day. You got a breakout but failed here 7533, which is very close to your 0.382 retracement level. You failed it here. It has made a high and this is a settlement price. However, the last traded price was different, 769495. I can show you that last traded price also. Last traded price of index future, Nifty, and this is for 2016. We are taking for the expiry of 28/4. So if you take these things here, last traded price on the Monday, it was 7695.3.55, very close and almost equal to your level of calculation, which is 0.888 level of calculation. So 0.888 level of calculations, this is what you have made. So this is the calculation we made and that is what we have achieved. Again 12th, if you see high 7738 you have made, this is the high we have made, and this is only 8 point below the high we have closed, and this 7738 is also one part of our calculation. 7738 also one part of our calculation. In fact, today we have achieved the all targets, and since there was a short covering action was there, we have crossed below that. So that too also we have achieved and gone below, gone above our projected level. So all in all, we have achieved most of the targets, but this closing basis highs and other things, it is well validated in the calculation. This also says that how true these particular calculations are. So whenever you do a trend forecast, it must be obliged by the market. In any method you can do, However, market should oblige it. So that is, then only you can say that that method is successful, or else not. Market must oblige it. Then only that method will be successful, or else not. And many people have asked many times that what are the processes we should follow for becoming a successful trader. Then I used to say that what is a good trend forecast method? All should agree with me in this particular idea. You calculate and it is obliged by the market. That is called a good trend forecast. Good trend forecast is nothing but, it is not that somebody has bought an option at 2 rupees, he got 10 rupees. That is not trend forecast. Trend forecast means you should well in advance you should project, and it should oblige by the market. Market should follow your calculation. Market should give respect to your calculation. That is what good trend forecast. How to be a best successful trader, get a best success in trade, do limited intraday trade, which always I used to advocate. Adopt hedging, be satisfied with your success, whatever you got. Hedging is must. If you overrule that part of hedging, then I can say that you are just for temporary period you have come to the market to lose some money. You have not planned your trade. So limited intraday trade, why I advise, is when your trade life cycle is very short, 10 o'clock to 3 o'clock, that time your decision process having a higher probability to go wrong. So henceforth, and your turnovers will increase, you will do more number of trades, that also lead to failure. So limited extent you should do, very limited extent, but have a planned hedging approach so that it can give you good success and get satisfied with your success. My friend invested 5,000 in an option, got 5 lakhs rupees return, so I should also jump in that. So that idea is quite wrong. Do not do that. Whatever stuff you have, be satisfied with that. Whatever success you get, that is your success, and get satisfied with that. So that is what I have 12 variety of products, one standard deviation software what I have shown to you. It can be utilized for intraday as well as the positional. And all these concepts of ours are proven concept. It is nothing a gray concept that we have just written some thesis to sell the product. We have made this product so that it should benefit you. You should learn something different. Whenever you open this book or learn that stuff, you must feel that yes, I am learning something new. So I am not learning some crap that it is not being validated, it's not being tested. So you can test all our concepts. That is the benefit of all our concepts. That is the concept. When you learn something, you always feel that yes, I am learning something new. When you test our method, that time you should think that yes, it is provable, I can able to prove these methods and it works. You feel the success like honesty. So these are the concepts and books you can get in our domain, and our courses are designed in that order. Thing is that you need one little bit of patience to read that. If you do not have a patience, just you bought a product and the next minute you are saying that you tell me in which page what is there, then only I will start reading, then I am sorry, it is not for you. If you have bought any of the educational literature, and as soon as you receive that product, you are saying that in which page, which concept you are written, which will work best for me, and you tell me that page number, paragraph, I will read that much and other things is useless for me, then I will say that sorry, this product is not for you. That is not you have not taken a good decision to buy this product. So that should not be the idea of your product purchase. Once you buy our product, have a patience, read through it. Couple of times if you read through, work out sincerely. All these stuffs are very quite easy stuffs. Anyone can able to master. Many things in this, many stuffs in this, many concepts are there. None of the concept is kept in hidden. Yes, for commercial compulsion, couple of things which is required for our software. For our survival, we have kept it as a secret. However, none of the concepts so far is maintained a secrecy clause in our company. It is open, you can able to use it. Only to level of accuracy what we have improved in the software, because there we maintain a little bit of secrecy that we have to make, otherwise we cannot survive. So that we have to make. That is our rights of our business. Stocks together, it costs you 17,500. If you buy separately, it has a different price tag.